Hello everyone, I'm Dr. Davilo, for those of you that don't know who I am, and today we're going to be discussing Bitcoin and also going to be emphasizing the volatility and the price estimates for Bitcoin itself. So, what exactly is Bitcoin? Well, Bitcoin is a cryptocurrency, and it's often abbreviated as crypto, and it is a digital or virtual currency, unit of account, or some medium of exchange, managed and secured by cryptography. So it's essentially an encrypted digital currency. Is the too long didn't read. And specifically, Bitcoin itself was the first digital currency, and it's the most widely used one. It controls more than 50% of the market in terms of cryptocurrencies, but it's not the only one. The idea was created by someone going by the name of Satoshi Nakamoto, although their actual identity is still a mystery to this day, surprisingly. Uh, but the white paper details how to use a blockchain to address the so-called double spending problem that's inherent of electronic currency circles and stuff. Now, if you wanted to actually get into crypto, there are some things that are worth mentioning before you can actually just go out and buy a bunch of it. So, first of all, it's worth mentioning that many exchanges have different tiers that allow you to perform either simple trading or professional levels of trading, etc. But you need to be very careful and do a lot of research on those exchanges that you are going to be using. In particular, I think the most recent example of a crypto exchange that failed miserably was FTX, which was Sam Bankman Fried's crypto exchange that resulted in um, extremely large losses for investors. It's also worth noting that there are these things in crypto trading that are called wallets, and these are a huge part, and they come in three different forms. There are hot wallets. These are wallets that are connected to the internet constantly. They're good for short-term trading, but they can be very dangerous, and they are easy to expose the information that's contained on the wallet. On the other hand, you could go opt for a more physical form of a wallet. In that case, that is something called a cold wallet. So these don't have any online connectivity. If they do have any, it is very minimal. But these are really good for long-term trading and storage of cryptocurrency, as they are usually considered quite secure. And then there are warm wallets, which allow you to switch between hot and cold, i.e., online or offline. But it's not just about whether or not you pick a good crypto exchange or whether you have a combination wallet that is versatile for your needs. It's also about the potential pitfalls when it comes to investing in crypto. And what I mean by that is there are several guidelines for getting into it. So, for instance, it's worth mentioning that you should always consult with your financial advisor as well as any legal experts in crypto. And it's and another very important thing for you to consider is to use a unique email address and a unique complex password. A lot of times what will happen is if people see that you use your personal email for your crypto investment portfolio, it's very likely what can happen is you can end up in a situation where someone can abuse the forgot your password um, option that you see on most crypto exchange websites and then steal everything that you own. So having your own unique address as well as a unique complex password is important, as well as employing two-factor authentication. You can use SMS authentication, but that is considered to be less secure than a standard authenticator app such as Google Authenticator or Microsoft's Authenticator app. But if you do opt for the text message route, it may be best to employ something called Google Fi, which is a special type of virtual SIM card that is much more difficult to hack. Virtual private networks are also very important when it comes to trading with crypto, as well as ensuring that you are using good browsing habits. So making sure that the website has the HTTPS tag at the beginning. And don't forget that you should always use both hot and cold wallets appropriately. Now, when it comes to investments, I tend to be really nervous about crypto. And the main reason why I'm nervous about it is because of the volatility. So cryptocurrencies are extremely volatile investments. They are even more volatile than a standard stock, and your return on investment can vary wildly, and with seemingly no impact from external sources whatsoever. It is an extremely volatile investment, and you really need to be careful about about exactly how much you put into crypto. You should not put anything that you can afford to lose into crypto. You should make sure that if you know for a fact you need some amount of money for you to do your everyday life and the rest of your investments, you should not put that money in crypto. The money that you put into crypto should be exclusively money that you know for a fact it will not be the end of the world if you lose it. And it's the volatility of Bitcoin especially has been studied extensively. So Kunimoto and Kakamu posted in a recent article in 2022 where they investigated the volatility for different days of the week as well as for holidays and stuff. And a lot of this involves the use of what is called stochastic calculus, which is calculus where the normal rule of a derivative existing, it does not exist, but the integral, the area under the curve, does exist. So it is a curve that is continuous but nowhere differentiable, which is the case with both stocks as well as the volatility and price of crypto. Having said that, there are still people that will continue to invest in it regardless of how volatile an investment Bitcoin is. So being able to predict the price of Bitcoin is a difficult task, again, because it involves the use of stochastic calculus. But there has been some study in it. So Patel et al. Has posted a recent study where they employed a very special neural network that uses stochastic differential equations and stochasticity implemented into the network itself in order to be able to eventually predict the price of Bitcoin. Again, because it is stochastic, this does require us to run numerous iterations of the model and then look at the expected value, and that can be very expensive to do in and of itself. But if you are able to navigate the volatility of Bitcoin and predict what the price may be, then suddenly you're going to be making a lot more money in the long run with your investment. And with that, I have finished. These are some of the references that I pulled together for this talk, and thank you for joining me today.